The most dangerous financial weapon aimed at America right now isn't a missile. It's a spreadsheet. And Washington has no idea how big it actually is. Here are the numbers the financial press keeps getting wrong. China officially holds $693 billion in U.S. Treasury bonds. That's the headline. That's what gets repeated on every cable network and financial blog. But the Council on Foreign Relations' top analyst on Chinese capital flows says that number is almost certainly wrong. Not because China sold, but because China moved. And the difference between those two words is the difference between a headline and a crisis. Stay with me, because in the next few minutes, you're going to understand something about American debt that most financial journalists have never explained correctly. And it connects directly to what you paid on your mortgage last month. Before we go further, if you follow financial news and you want the analysis that goes one level deeper than the headlines, subscribe now. We break this down daily, not just when it hits the front page. Start with a document most Americans will never read. The U.S. Treasury Department's own FAQ states explicitly that when a foreign government holds Treasury bonds through a custodial account in a third country, the true country of ownership is not reflected in the official data. Read that again carefully. The system the United States government uses to track who owns American debt records where the bonds are held for settlement, not who actually owns them. The custodian and the beneficial owner are two completely different legal entities, and the U.S. government's official tracking system makes no attempt to tell them apart. That single sentence, buried in government documentation, almost never quoted, is the most important piece of context in this entire story. Because here is what that means in practice. While China's official treasury holdings appear to have dropped by $600 billion over recent years, Belgium's holdings mysteriously surged by $500 billion over the same period. Belgium, a country with a $600 billion GDP, now officially holds $481 billion in American government debt. Luxembourg holds another $425 billion. And Bank of America's own strategists identified the pattern directly, stating that China is the only foreign official player that fits the Belgium numbers. Those are not Belgian investments. They are Chinese assets, repositioned into European custody infrastructure, specifically into Euroclear Bank in Belgium and Clearstream International in Luxembourg, for one precise strategic reason. And that reason starts with Russia. In February 2022, the United States government froze $300 billion in Russian central bank reserves overnight. Every reserve manager in Beijing watched that happen in real time. Every single one of them ran the same calculation. China holds $3.3 trillion in total foreign exchange reserves. If U.S.-China relations deteriorated over Taiwan, over trade, over any flashpoint, could Washington do to China what it just did to Russia? The answer reached in Beijing was possibly yes. And the rational response was to move positions, not sell them. Move them from U.S. visible custody into European settlement infrastructure, specifically designed to be outside American financial surveillance reach. The bonds did not change economic hands. The beneficial owner stayed the same. What changed was the geography of custody, and with it, the degree of Washington's practical ability to monitor or act on the position if tensions escalate. Now, here is where the number gets truly alarming. And this is the figure almost no coverage mentions. When you go beyond the PBOC's official position and add China's state commercial banks, which expanded their dollar book by over $1 trillion, add the China Development Bank and China Exim Bank, which hold close to another $1 trillion in dollar-denominated international lending, add the China Investment Corporation's sovereign wealth fund at approximately $450 billion, add offshore vehicles like Buttonwood, and then add custodial positions in Belgium, Luxembourg, and the Cayman Islands. Here is what you find. The Cayman Islands is now officially the single largest foreign holder of U.S. Treasury bonds in the world. A British overseas territory in the Caribbean, home to thousands of hedge funds and offshore structures, officially holds more American debt than Japan, more than the United Kingdom, more than China's disclosed position. The official data isn't telling you who owns American debt. It's telling you where the paperwork sits. Stay with this next part, because this is where it stops being an abstract geopolitical story and starts being your monthly payment. The 30-year fixed mortgage rate in America tracks the 10-year Treasury yield, not the Federal Reserve's overnight rate, the 10-year. When Treasury yields rise because demand weakens against the enormous supply the U.S. needs to issue, $11 trillion in fiscal year 2026 alone, mortgage rates rise with them. Currently, the 30-year fixed sits between 6.75% and 7.25%, historically elevated even after multiple Fed rate cuts. Eric Hagan, mortgage and specialty finance analyst at BTIG, said it directly. Most investors are concerned that mortgage spreads would widen in response to China, Japan, or Canada coming in with a retaliatory objective, and that the lack of visibility about how much China could sell would scare investors. That widening of mortgage-backed security spreads pushes the 30-year rate higher independently of anything the Federal Reserve does. The uncertainty itself is already priced in. It is already in your mortgage statement. Now, the most important question. Is China actually planning to use this as a weapon? Here is the honest, balanced answer. China's deputy central bank governor stated publicly that one single asset change in a single market will have limited impact on reserves. The PBOC's own holdings are explicitly exempted from the February 2026 directive to commercial banks and asset managers. Brad Setzer's analysis shows China's consolidated dollar exposure may not have declined meaningfully at all when the complete picture is assessed. The rational economic logic of mutual destruction is real. Selling at scale drives down the value of China's own remaining holdings, strengthens the yuan, which damages Chinese export competitiveness, and destabilizes the global markets China depends on. But MIT economics professor emeritus Olivier Blanchard published an observation that should stop every American investor cold. He noted that China appeared willing to sell treasuries, even absorbing capital losses, and then added, given its political regime in a game of chicken, the Chinese autocracy can absorb bad news for longer than the Trump administration can. That asymmetry, one side with domestic political pressure, the other without, is where the genuine danger lives. And there is already one data point that demands an answer. In the week of April 7th through 11th, 2026, the 10-year Treasury yield surged 50 basis points, the largest weekly move since 2001. Stocks and bonds fell simultaneously, the classic signature of capital leaving U.S. assets entirely, rather than rotating within them. The overnight moves during Asian trading hours were disproportionately large. A Tokyo-based interest rate strategist published a formal client note stating directly that China may be selling treasuries in retaliation. There was no confirmation. There was no official admission. There was only the data. And the data pointed in one direction. China has not dumped its treasury position. The custodial architecture confirms the true exposure is larger than $693 billion, not smaller. The February regulatory directive exempted the PBOC entirely. And Setzer's consolidated analysis suggests China's total dollar exposure may be flat or quietly rising when state banks, policy banks, and sovereign wealth funds are properly included. So the story that China is exiting the dollar system is wrong. But the story that it doesn't matter is more wrong. Because China has built an architecture around its treasury position specifically engineered to move without early warning. Positioned offshore, invisible to U.S. surveillance, protected against sanctions, distributed across Belgium, Luxembourg, the Cayman Islands, state banks, policy banks, and sovereign wealth funds. Not because it will definitely be deployed, but because its existence, its opacity, and the geopolitical climate surrounding it make uncertainty permanent. And permanent uncertainty in the world's most important bond market has a price. Americans are paying it every single month. Share this with someone who thinks China's treasury position is just a number in a data table. It is the most geopolitically sensitive pool of capital on Earth, managed and signaled with precision by a government that has spent decades playing the long game. Drop a comment right now. Do you think the April 2026 Treasury sell-off was calculated retaliation or coincidence? The answer changes everything about how you read every trade headline going forward. If you want the financial analysis that goes behind the headline every single day, not the panic, not the spin, the actual architecture of what's happening, you already know what to do.